You could spend decades building your wealth, only to hand the IRS six figures, because almost nobody tells you this account exists. Stay until the end where I answer the 3 most common questions about this. The tax surprise. Most Americans saving in a traditional 401k believe they are deferring taxes wisely. They are not. They are delaying the bill until the moment they stop earning, and the IRS collects its full share of everything built over decades. The traditional trap. A traditional 401k gives a tax deduction today and taxes every withdrawal in retirement. Most Americans accepted that deal without knowing a completely different one existed, one where the tax never arrives at all. The lifetime tax. The average American with a fully funded traditional retirement account will pay a 6-figure tax bill on withdrawals. The money spent decades compounding comes out taxed as ordinary income, every dollar earned twice. The RMD problem. Traditional retirement accounts force minimum withdrawals starting at age 73, whether you need the money or not. These become taxable income automatically every year. A Roth IRA has no required distributions, ever. The rate gamble. Saving in a traditional account is a bet that your tax rate in retirement will be lower than today. Most Americans who actually build significant wealth find themselves in the same bracket, or higher. The bet loses more often than anyone plans for. The bracket surprise. Social Security combined with traditional retirement withdrawals pushes millions into higher tax brackets than expected. The low rate assumption does not survive actual retirement math. A Roth IRA removes the bracket problem permanently. The heirs tax. A traditional retirement account inherited by a non-spouse must be fully distributed within 10 years, during the heir's own peak earning years. A Roth, inherited under the same rule, distributes completely tax-free. Same timeline, completely different tax outcome. The opportunity window. The Roth IRA income window closes when earnings exceed the contribution limit. Most Americans spend their entire 20s and early 30s fully eligible and never open one. That window closes permanently and silently. The flexibility difference. A Roth IRA allows withdrawal of original contributions at any time. No taxes, no penalties. A traditional account charges 10% plus ordinary income tax for the same move. Only one of these accounts is also an emergency fund when everything goes wrong. The compounding clarity. Every dollar in a Roth IRA compounds with one permanent advantage. None of it will ever be taxed. Not the growth, not the dividends, not the withdrawals. The number in the account is the number you keep. Question number 1. What exactly is a Roth IRA? How does it work, and what makes it different from a regular retirement account? The basic definition. A Roth IRA is a retirement account funded with money you have already paid tax on. Everything inside grows tax-free. Every withdrawal in retirement comes out completely untaxed. That is the entire mechanism. The after-tax advantage. Traditional accounts tax the withdrawal. A Roth taxes the contribution. For any investment expected to grow significantly over decades, the Roth wins, because you pay tax on the seed, not the harvest. The 5-year rule. Roth IRA earnings cannot be withdrawn tax-free until the account has been open at least 5 years and you are 59 and a half. The clock starts January 1st of the year you make your first contribution. Opening early, even with $1, starts it years ahead. The income limit. In 2025, direct Roth IRA contributions phase out at $150,000 for single filers and $236,000 for married couples. Above that range, the backdoor Roth conversion remains fully available. Most Americans eligible for the direct path never use it. The contribution limit. In 2025, the maximum Roth IRA contribution is $7,000 or $8,000 if you're 50 or older. This is a combined limit across all IRAs. You cannot contribute more than your actual earned income for the year. The earned income rule. Roth IRA contributions require earned income, wages, salary, or self-employment. Investment income, rental income, and Social Security do not qualify. A working spouse can fund a full spousal Roth IRA for a non-working partner. The investment freedom. A Roth IRA is a tax-free container. Inside it, you can hold stocks, bonds, ETFs, index funds, or REITs. Most beginners start with a single low-cost index fund and never need anything else. The contribution flexibility. Unlike a 401k, Roth IRA contributions are made directly by you at any time during the tax year or up until the April 15th filing deadline of the following year. You control the timing, the amount, and the account entirely. The no employer required. You do not need an employer to access a Roth IRA. Freelancers, self-employed workers, and anyone with earned income can open one independently at any brokerage. It belongs entirely to you, no employer, no permission required. The early contribution rule. Original Roth IRA contributions can be withdrawn at any time tax and penalty free because you already paid tax before contributing. Only earnings carry withdrawal restrictions. The Roth is the only retirement account that never fully locks your money away. Question number 2. What are the rules, limits, and things most beginners get wrong about their Roth IRA? The backdoor option. If your income exceeds the Roth IRA limit, contribute to a traditional IRA and immediately convert it to a Roth. This backdoor strategy is completely legal and widely used. High earners who know it preserve Roth access permanently. Most who qualify never hear about it. The missed deadline. Roth IRA contributions for a prior tax year can be made until April 15th of the following year. Most Americans assume the window closes December 31st and miss it entirely. A single January contribution can close a full prior year funding gap. The small start mistake. Most beginners wait to open a Roth IRA until they can contribute the full amount. The 5-year clock does not care how much you put in. $1 starts the account and starts the clock. And every year of delay is a year the clock did not run. The cash mistake. Opening a Roth IRA and leaving the money in cash is the most common and most expensive beginner mistake. A Roth IRA is an investment account, not a savings account. Cash earns near zero and receives none of the tax-free compounding the account was designed for. The withdrawal order. The IRS withdraws Roth IRA contributions first, then earnings. Original contributions can always be pulled tax and penalty free at any age. Only reaching into earnings before 59.5 and before the 5-year mark triggers the penalty. The spousal IRA. A working spouse can fund a Roth IRA for a non-working partner using their own earned income. This doubles the household's annual Roth IRA contribution capacity. Most married couples eligible for this have never heard it exists. The rollover option. Leaving a job with a Roth 401k? Roll it into a personal Roth IRA tax-free. Leaving with a traditional 401k? Convert it to a Roth by paying tax on the balance now, making all future growth permanently tax-free. Job transitions are one of the best conversion opportunities most people miss. The custodian choice. A Roth IRA is held at a brokerage. Fidelity, Vanguard, and Schwab are the top 3 for beginners. No account fees, no minimums, and index fund expense ratios below 0.05%. The custodian choice matters far less than the decision to open one. The age myth. There is no maximum age for contributing to a Roth IRA, only an earned income requirement. A 60-year-old with part-time income can open one today and access tax-free withdrawals within 5 years. The age myth stops more people than the actual rules ever do. The inheritance advantage. A Roth IRA inherited by a non-spouse must be distributed within 10 years, but every dollar comes out completely tax-free. The same rules apply to a traditional account where every dollar is fully taxed. The Roth advantage survives death and passes intact. Question number 3. How does a complete beginner open, fund, and invest inside a Roth IRA starting today? The opening step. Open a Roth IRA at Fidelity, Vanguard, or Schwab. All 3 are free with no minimums. The online application takes 10 minutes. Social security number, bank account, mailing address. The hardest part is the decision. Everything after takes 10 minutes. The first contribution. Link your bank and initiate a transfer. Even $50 completes your first contribution and starts the 5-year clock for the year the account was opened. The amount does not matter. Starting does. The investment decision. Contributions sit in cash inside the Roth IRA until you invest them. For most beginners, a single S&P 500 index fund is enough. Complete diversification, near zero fees, and every dollar of growth permanently tax-free. Buy it once, let it run. The annual habit: make Roth IRA funding. An annual habit: set a recurring transfer and increase it as income grows. A beginner contributing $100 per month from age 25 builds a 7-figure tax-free account, not from the amount, but from the consistency. The max priority: max the Roth IRA before any other investment account, except the 401k employer match. The $7,000 annual limit is use it or lose it. January 1st closes the prior year permanently. Unused contribution space never carries forward. The index selection: choose index funds with the lowest expense ratios available inside your Roth IRA. At Fidelity, FZROX charges 0. At Vanguard, VTI charges 0.03%. At Schwab, SWTSX charges 0.03%. The difference in fees over 30 years of tax-free compounding is not small. The dividend reinvestment: confirmed dividends are set to automatic reinvestment inside the Roth IRA. Every dividend reinvests into more shares automatically, and because it happens inside a Roth, every resulting gain is permanently tax-free. Set it once and never touch it. The review schedule: a Roth IRA does not require active management. Set one annual reminder in January, contribute, confirm your fund selection, verify dividend reinvestment. That is the entire annual checklist. Everything else is noise. The backdoor setup: earn above the income limit, open a traditional IRA, make a non-deductible contribution, then convert it to your Roth IRA immediately. Report it on Form 8606. That is the complete backdoor Roth, fully legal, done in the same tax year. Tax-free forever. The US government created a retirement account that grows tax-free, withdraws tax-free, and passes to heirs tax-free, with no forced distributions ever. Most Americans never fully used it. The second best time to start is right now. If you found this helpful, consider subscribing to stay updated with our latest videos.